chart, with the only difference being a shade below one or the other, in the sense that we see a little bit of a darkened area beneath it, and just the simple nature of what did price do over this period of time. Now, why do we potentially want more nuance ultimately when we think about the different types of candlesticks? Well, the main reason is that we want to try to get a little bit more information out of what the traders were really doing on that day in particular. And that's what we're trying ultimately to derive with the two major types of constructing different charts. I want to mention, of course, you do have the ability open, high, low, close. This tends to be another popular type of charting setup, in the sense that we see a little bit more information. So what is the main difference between this from a mountain chart, and then we'll move into a candlesticks? On a mountain chart, the only thing that we are seeing is the plotted closing values over this defined period of time. I'm looking at a weekly period just to make things look a little bit more clear on the screen from this time frame in particular. But when we are using a line chart, we only see that closing value on a weekly perspective, the Friday close or whatever day that it closed. The difference on an OHLC, a bar chart, is what you will generally hear when this is the case. I'll zoom in to a shorter time frame so we can see this with a little bit more granularity, is we add 3 additional in the mix. Instead of only looking at the close, we are also looking at the open, the high, the low, and again, like I mentioned, the close. So why is that important? Well, it gives us a little bit more information about the just general relationship between buyers and sellers that day, the true battle that we saw in the markets that day. Because sometimes, the old school saying, of course, is that the close is the most important price of the day, because that's where the market ultimately finished itself at the day. But how it got there, the path with which the market took, is still an important piece of information. So on a bar chart, again, we can see the open, high, the low, and the close. How that is dictated are these sticks, but also these just knocks to the offside here that we see on this, say, candlestick in particular, November 2020. We opened up at 32.96. We see price move up to 35.29. That's quite a move. I don't remember exactly what happened in November of 2020. That's roughly a 10% move almost. We then close at 35.09. This move to the right-hand side, and the low during the day was probably near that open at the 32.79 area. We see that relationship. So what is the difference when we move from a bar chart to a candlestick chart? We really just fill in a little bit more information. It makes it just simply a little bit easier on the eyes, in my opinion. That same day, what did we find? Well, again, we opened at 32.96. We traded down to 37 or 32.79, up all the way to 35.29, finished the day at 35.09. That is found by the body and wicks of these candlesticks. So what does a candlestick actually comprise itself of? We have the opening value and the closing value. That is dictated by the body of the candlestick. If the close is higher than the open, we dictate that by a green candlestick like we find here. To the left of this, we see that there is a red candlestick because the close was lower than the open. A red day. Remember, the only major difference between that and a bar chart, and of course the aesthetic differences, but a bar chart bases green or red or whatever color we so choose off of the prior day's close. So very much like when you see, is it a red day or a green day across the broad markets, it is within respect to what the prior day's close was. A candlestick is looking at things within the confines of that day or that frequency in particular. It's a weekly move that we had here. That this period of time, again, we opened the week at 32.96, traded up to 35.29, closed at 35.09. That is dictated by the bodies of the candlestick. The high and the low is what creates what is called the wick of the candlestick. We have a wick higher or a wick lower dictating that there was a move high and a move low. This candlestick in particular, we see that most of the candlestick is comprised by the body. Say if we look at this one here, that the open 37.31, the lowest 37.25, 6 points of difference, almost the exact same level. Same thing could be said to the upside, 38.94 high, 38.86 close. Essentially, we only really have a body of the candlestick. Now, where does it look slightly different is on this one in particular. This is a area that we saw it opened, was it 38.42 and it closed at 38.41. Essentially open and close at the exact same value. We'll go over what types of candlesticks this might be in just a moment, but that is where we see that the market opened and closed at exactly the same level, but we see with a little bit of that additional granularity that the market itself did move higher and did move lower during that period of time. In fact, there's about a 200-point difference, about a 5% move at that moment between the high and the low, just for the week to end up exactly where it started. Again, if you were simply just looking at a line chart, you wouldn't get any of that information out of it, because the only thing that you would see is that we close essentially right where we roughly opened the week at. We wouldn't see that we did trade higher and did trade lower, because we're losing out on that additional nuance from the concept of what we can get from this candlestick. So how do we then use that from the approach of the purpose of a candlestick? What are we ultimately trying to derive from it? We're trying to derive that relationship of buyers and sellers. Can we get a little bit more information about what ultimately happened during that period of time? I'm going to back out because I think there's maybe one good example from not too long ago. In fact, let me switch this to a daily perspective, and let me zoom in to really the year of 2022, because there's one really great example of how we can get additional information. Again, we'll go over different types of candlesticks. This is a many centuries old approach of looking at trading. It was originally created, I believe, in the 1600s, originally by Japanese rice traders, taking a look at that influence of buyers and sellers at important levels. But look at this moment in particular. What we now know was the 2022 low back in October of 22. What did we do that day? Well, we closed on the day before at around 35.77. We actually opened up very much lower, below 3,500, a sizable gap down. And then we saw prices push significantly up higher during that trading day in particular. In fact, the low 34.91 and the high 36.85, about a 200-point difference between the low and the high that day, creating a very large body of the candlestick. So with that, we can really glean some information that something in the narrative must have changed that day for all of these buyers to push prices up higher in such a significant way. And again, what if we weren't using candlesticks or a bar chart for that matter? What if we're looking at a mountain chart? If we do a mountain chart for that day, it doesn't really look like anything important happened. It looks like we just kind of just moved up higher. And if that was the only thing that you looked at, if we kind of, closed our eyes and only looked at from a day-to-day basis, we wouldn't really see how important that kind of thrust from the lower end was that day in particular. We can only see that there was a move higher that day. So the idea of what I mentioned earlier, Eastern and Western technical analysis, is this idea of not just observing what type of candlestick that we're looking at. We'll look at the different definitions of candlesticks in this session, of course, but also blending it with where something happened and what candlestick that we are ultimately getting at that moment in time. Because if we think back to some of the things that we were thinking about and trading based off of during that period of time, you'll notice that this move to the lower end was essentially a Fibonacci retracement of the COVID pandemic coming out of that move. That 3,500 level also more or less represented this high that we had during the September timeframe of 2020. So we can see when we look to the left, using that idea of what we call Eastern technical analysis, is that that was an important level of support. It had been a prior level of resistance a few years ago. We would want to see that hold as a concept of support. And when we got to that point, we saw a very large influx of buyers coming in at the exact area you would want to see an influx of buyers. So we get a little bit more information, that confluence of evidence that we are ultimately trying to get at any given moment in time by not just seeing where price interacted, but also to what extent did buyers and sellers interact at that moment in time. So we'll go over a handful of different candlesticks here today. The first kind of air of caution that I would say with candlesticks is that in and of themselves, I would not consider them a trading system. If the only thing that you ever traded was just the candlestick itself, a lot of these candlesticks are not entirely used from that perspective. We always have to remember technical analysis is not predictive. It is reactive. It is looking at pieces of evidence to help us make an informed decision around where we believe things could go with a degree of probability. So we always remember that because we see, doji, harami, engulfing candlestick, it does not dictate what is going to happen next. It just gives us an output of where buyers and sellers really created price action that day in particular. Is there accumulation taking place? Is there distribution taking place? Can we point and paint a narrative around what could happen next with that new information, with this additional granularity that we get from a candlestick? But I'll mention, some of these candlesticks, they sometimes have maybe a coins flip chance of dictating probabilities. There's a few traders who have back tested a lot of different candlesticks, and some are a little bit more useful than others, and some, there's not a whole lot we can glean from. So we'll go over some of the major well-known candlesticks here today, but one concept that I think is a good, important takeaway too is something that a colleague of James and I's on the desk likes to say when it comes to candlesticks. He doesn't get too in the weeds about different names of these candlesticks and more just refers to them. Did we see a baseball or a baseball bat candlestick here today? Did we see something small and almost a idea of indecision and equilibrium? Or did we see a large difference in the price action that day in particular? If I clean this up for a brief moment, see where we're at on the last 2 days worth of sessions, you see that there's a few days that are those baseballs versus those baseball bats. Large green candles or large red candles versus those smaller body candles or even ones without much of a body itself. You'll notice today in particular, we are getting kind of an indecision style candle. We moved lower, we moved up higher. We're back to roughly where we started at here today. We've got an hour and a half, give or take, for the rest of today's session. So we'll see how we end up. But that's an important distinction that we see price going up back to a prior level and finding sellers. If we think back to this level in particular, it had been this concept of congestion and digestion, so to say, this moment. Where did we get to here today? We traded right back up to it, found some sellers interacting. This idea of buyer and seller interaction at different levels on the chart is something that we use as candlestick traders to somewhat get an idea of what happened that day in particular. But no, I've been going for a few moments here. I wanted that James have a couple minutes to talk. Anything that you wanted to add to the kind of core concepts of candles before we look at a few ones in particular there, James?
I think it's great because we absolutely have to kind of compare, right, some of these different kind of chart styles because I think many folks, at least initially, when I come across someone, they're sticking with those default bar charts, that OHLC that's defaulted within Active Trader Pro, and they're great. They are nice and simple, and they're for the most part easy to read as long as you're not too far zoomed out. But candlesticks, it's nice just having that extra piece of information. And maybe one other kind of aspect that we can also kind of quickly talk about is just, and I'll kind of flip back and forth between the kind of the, we'll flip back and forth between the classic look and I guess what I would say the more modern look that Andrew has on his chart here, where kind of the, I don't want to say, well, the intraday up candle is green and where the intraday down candle is red. And because our slides show some of the classic look, I want to kind of keep it on the classic look just for a moment here where, right, if we're kind of zoomed in just in this period on SPY, just on a 1 year chart, right, we can see green and red. Now, if I were to go over to settings, and instead of choosing candlestick filled, went to the standard, take a look over kind of at the right-hand side now, where the green has now kind of disappeared, right? It's now a white candle, at least on our chart. And the red is still remaining filled. And that's really based on kind of the older times when adding color might not have really been a possibility, right? We're thinking of possibly charting 50 years ago when folks were printing out charts. Well, that color ink might have cost more. They may not have had it. So how would they differentiate up from down candles? Well, in the classic look, it would be hollow versus filled. Again, these are our kind of up candles where the close is higher than the open. And these are our red candles where the close is lower than the open. So we can possibly keep bouncing back and forth between these two styles, but I wanted to leave us off with the classic look as we kind of get started with some of the chart patterns that we're going to discuss today. And some of you, especially if you went through our technical analysis class and downloaded the slides, some of you might be familiar with at least some of the names here. Now, this is taken from our kind of common chart pattern class, where in the classroom, we don't even get the opportunity to go over candlesticks. We save it for its own session here. We label it an intermediate because we imagine most folks would have at least gone through the common kind of multi-bar patterns, the triangles, the tops, the bottoms, head and shoulders, for example, cup and handle. So these are going to be the patterns that are going to be discussed today. We're going to have 6 different of some of the most common candlestick patterns. Now, there are far more patterns out there than these 6, but I think these are going to be kind of maybe good patterns to get started with. They're going to be labeled just strictly 1 and 2 bar patterns, meaning kind of one period that you're looking at. Think if you're on a 1-year daily chart, each candlestick is comprised of 1 day. So that's what's considered a kind of a one bar candlestick pattern. Or 2 would have 2 days. And if we were on, say, an intraday chart, maybe looking at 1-minute candlesticks. Okay, that 1-minute candle is that kind of 1 bar. 2-minute 1-minute candles are now 2 bar, right? We're not going to be talking about some of the more complex ones, some like going out to kind of 3 candlesticks. So we'll try to keep it at least more so introductory, and again, with some of the more popular ones that exist. So starting with the first one, I'm going to need to kind of jump over to our just general information, right, about candlesticks, just to go maybe kind of a quick kind of review here. As Andrew talked about, these have been in existence for quite a while, originating with rice traders. And traditionally, right, candlestick patterns are reversal patterns, meaning they are used to identify when a trend is reversing. And remember, that contrasts with when it comes to patterns. Think of those regular kind of multi-bar patterns. They're either continuations or reversals. They're either going to reverse the current trend or they're going to continue the current trend, meaning price will be on one trend, enter said pattern, and then either reverse it or continue that prior trend. So bullish trend goes into a pattern and leaves going upward. It's a continuation. If it leaves downward, it's a reversal, and right vice versa with a bearish trend. And that doesn't necessarily mean, and this is the thing with technical analysis, is going back to that art form where there's quite a bit of subjectivity, right? Traditionally, they're thought of as reversal patterns, but they can absolutely be part of a kind of continuation pattern as well. And because of that, I guess we can say kind of inconsistency. It's not right, predicting the future. So all because it does exhibit this candlestick pattern doesn't mean it will be reversing or will be continuing, but it's meant to possibly give us clues. I wouldn't necessarily want anyone here to be kind of specifically trading just on that signal and that signal alone, meaning that formation of that candlestick, but it could at least be something that you observe and you consider what that could mean. And some of these candlesticks, I like to explain them because they can possibly talk a little bit about the kind of market's mentality or the behavior of traders and investors for that particular day. Now, just like all type of kind of pattern analysis and pattern trading, we want to be careful not to act on a perceived candle pattern until it has been formed and activated by that breakout within that specific direction, or either upwards or downwards. So keep some of these kind of ideas in mind. And this is really based on kind of very similar concepts to how you would trade other patterns, your double tops, your double bottoms, triples, your triangles, and so forth. You're waiting for that breakout to confirm that the pattern is taking place. So getting started with our very first pattern today, and that is going to be the doji. Now, it is possibly the simplest and easiest to identify, but I think it's oftentimes a really good one just to be aware of and kind of what it's indicating for you. Now, what is this pattern? So it's a one candle pattern formed when the open and close are the same price and the high and low are roughly equidistant from the open. So we can see that kind of textbook definition here in the middle, that equidistant high, equidistant low from the day. The open and the close were pretty much on top of each other, right? We can't expect it to be a penny to the price, but they're more or less supposed to be very, very closely aligned there. And this is meant to indicate indecision in the marketplace. And think of this from an intraday perspective. If we're looking at a, let's say, daily candle, and this was a snapshot from a longer term chart, and all of these candles are one day. The market opened at one price. The bulls thought they could rally it upward. They failed, came back down. It was then lower from that open and then bounced back up, right? Either it went down first or went up first. Ultimately, nothing happened, at least from the intraday perspective. Now, understand that it doesn't necessarily mean that it was a flat day, meaning no change in price, because when we look at change in price, it's based on the prior close. So this doji, for example, that day was still a green day. It was a positive day because the close is higher than the previous close. But there was indecision, right, within the day. No one could really decide if they wanted to keep that trend going or reverse it within the day. And when you were looking for these types of dojis, there are some, I guess we can say, kind of modifications of it. Again, maybe this is more of like a bonus to this. And those bonuses could be what happens if the open and close is at the high of the day and it's all kind of a stick or a wick to the downside. When the open and close is at the high, well, this is what's considered a dragonfly doji. When the open and close is at the bottom, so imagine if it was down this lower portion, well, that would be considered a gravestone doji. And dojis are oftentimes used for primarily to signal that indecision in the marketplace, but then from a secondary perspective, could be the beginning of a reversal in trend, right? Indecision could signify that, okay, they're not sure that they want to continue that trend, hence the reversal the following day. And when we're seeing these kind of modifications, the dragonfly, when close at the top, right? Think of what a dragonfly is with that long tail. It's an easy way to remember it. Versus the gravestone doji at the bottom. If both of those appear at kind of market tops or market bottoms, that could be the sign of a reversal. Typically, a dragonfly doji at a market bottom could be a sign of a reversal, and a gravestone doji at a top could be a sign of a reversal. So let's kind of jump into back over to Active Trader Pro and maybe take a look for some dojis on our chart. And let me go back to a kind of a little more of a present point in time. And Dave, I saw your comments, a similar to SPY today. So we can kind of take a look at today's kind of price action here. And this goes into kind of that subjectivity, right? So this is the daily candle on SPY at the moment. And it is filled. So what does that mean? That means our open, I put it right on that line. Maybe I can't grab it once more. Let me try to add it once more. Try to put it right on that opening price, right? So our open was higher than our close. So Dave, at this point, I think by most folks, it couldn't be considered a doji. Could it become a doji? It's still possible, right? We'd probably have to see a lower low put in to extend this bottom wick, and then right, it would have to rally back closer to this 541.47. The actual open was 541.35, but again, close enough oftentimes that we don't have to see that perfect line, but at least closely centered within that middle. So just with the skew of the kind of high point further away than this kind of main candle body, might be a little bit tougher to call this a doji. But let's take a look through SPY, and it is considered more or less a fairly kind of common pattern. So there are maybe some of those kind of versions of it that could be brought up here, where I talked about that kind of gravestone doji. And this again could be going back to that subjectivity of it, right? Looking at this candle here, the open and the close, 415.47, 415.51. It's 4 cents difference. Yes, we can see a little bit of black, but some may say, hey, 4 cents on a 500, or in this case, it was a $400 ETF, that could be considered close enough to be a similar opening close. And the low, 415.27. Okay, so right, it was 20 cents, but on a range that day that got as high of 417.62, a low of 415.27. So maybe $2.40 here. Well, again, they may consider that on the kind of close enough side. And that kind of indicates that indecision that took place, where it rallied very high, but still came right back down to that opening price, which was pretty much at the low of the day. So this was, as we talked about, that kind of gravestone doji, where, and especially when we see this at a market top, this could be a sign of a reversal, right? So at this point in time, it was following, right, two fairly strong days within SPY, and we put this into kind of perspective here. From close, 3%, so around a 3% kind of rally over those 3 days, but the indecision couldn't rally it to the upside, and we can see, zoom back out here. Oh, we lost it on the chart, but it ended up pulling back at that later point in time. So I'll zoom back in kind of once more, right? It ended up declining and kind of losing, right? That same 3%. So I think this, if anything, can be a fairly kind of positive kind of signal of, well, we're getting some indecision within that marketplace. And we can kind of keep looking through a few of these as well, where looking for those kind of dojis, and we might have that put that subjectivity in, right? That, well, how close are we going to go? How close do those candle bodies need to be? And we'll show some other tools that we can kind of bring this back in an example. But as you kind of look through these pieces on your charts going forward, I think the key aspect is going to be that very, very similar opening close. And either it's going to be in the middle or towards the top or towards the bottom for it to fall into one of those categories. So that is going to be the doji. You know, something kind of popped out in my mind here, right? At this point, we might consider this a little bit off. It's not fully centered, but again, it's that somewhat close enough to an open and a close. In this case, about 24 cents. So this might go back to that kind of subjectivity. Well, how close is it going to be? In this case, we can see the downtrend did end up continuing. So I'm going to go back and let me talk about one more pattern here, and to introduce a two pattern candlestick kind of, I guess we can say, display here, and that is going to be the harame, or the harami, depending on how you want to pronounce it. Of course, as you can possibly tell, I know nothing of Japanese. And I've been told, and what this is, what this means is pregnant in Japanese, or it's closely related to the word pregnant in Japanese. And well, possibly you can see why, right? If this is a mother here, right? that is that kind of a baby, we can say, kind of think of that kind of belly that's sticking out. Well, that's going to be possibly where the term is coming from. Again, the mother with the baby. So we try to put these ways to possibly kind of remember what these patterns are going to look like. So as we talked about, this is a two candle pattern of a large body of either color. So that's going to be key, right? It can be both the hollow or filled, meaning it can be green or red, followed by a smaller body of the opposite color. Now that second body is completely within the body of the large body and is called a kind of spinning top. And as you can see here, again, that kind of spinning top, it's meant to look such as that. But notice how it's completely within. So the range of movement between that open to close was lesser than the prior day. So we may even say, right, to some extent, this could even be a kind of lower volatile day on average when looking at this pattern. Now, a common belief here is that the Harami is a reversal pattern, but many report that it's a potential breaking either way. Again, this goes back to that even though it's classically may have one idea, enough kind of observers have noticed it can go either way. And if you're wondering kind of where some of this data is coming from, we do have the source here down at the bottom. So again, we've got the larger body and the smaller body, larger body and the smaller body, two opposing colors. So with that, we can possibly jump back over to kind of Active Trader Pro just to take a quick kind of look at this from our perspective. And I like sticking with SPY. Let's see if we can find a possible SPY example in recent time here. And ideally, if you're going to be kind of using this, we would it's helpful to see it kind of fall closer into the kind of the middle of that prior body. But in this case, right, we have a bit of an example here. Does this meet those requirements? Well, you may say yes, right? In this case, the following body, the second body is completely within the body of that larger body, and they are kind of the opposite colors. And in this case, did it end up being a reversal pattern or did it end up being a continuation? And that's going to be kind of on the time frame that you're looking at. So here we had kind of a 1%, right? This is our kind of base. This is our beginning. We move over here. It did increase slightly, but I would say more folks would say this could be that kind of continuation pattern. We were going down. We entered our pattern. So let's kind of designate the pattern here. And we continued kind of that prior downtrend. In this case, roughly about a 5% move to the downside here. So it's not always going to look exactly kind of like that textbook example where it's going to fall perfectly within the middle, but we can kind of find these, and here we go, right? Another kind of example, similar to what we just looked at with the field body and the hollow body kind of encompassed by the prior. And in this case, we may say a bit of a kind of continuation pattern. And I think this kind of somewhat, even just the quick examples that we used, might be kind of supporting that kind of further, that more kind of commonly reported kind of take that this has been a kind of a continuation that has had the potential to break in either way. It's not necessarily a reversal pattern that's being established here. In both of our examples, we saw continuations. So Andrew, in the theme of maybe just covering kind of two at a time, unless you wanted to add anything on that, we can jump over to the next kind of two patterns that we have in store for everyone.
Yeah, absolutely. You know, the kind of main takeaway I would say with dojis and haramis is indecision. We are seeing maybe not even always indecision, but a balance of sorts. That's the main kind of component of those two candlesticks is that on one, we just see a balance, an equilibrium of buyers and sellers. On Harami, we are still seeing that, but it's followed or it is following a day of a lot of buying to the upside or selling to the downside. So indecision that was preceded by decision. So it's that sometimes digestive type of move. And that's the interesting thing component of kind of both of those is that we have to remember the market is not always moving in at least a trending sort of way. Sometimes markets are digesting price action. We sometimes see the lack of volatility after some moves like that. And Aramis do that to some degree. Now, is that something that could still be very important from the trader's perspective? Yeah, imagine if you had been someone following a degree of strength in the marketplace. Imagine you had been a buyer of strength, and then all of a sudden you get a doji candlestick at the top of that trend, or you get a gravestone doji at the top of that trend, or even if you just get a Harami candlestick. Now, does that make you maybe a little bit nervous about the continuation of that? Is that slowing of strength something that a little bit at your overall bullish or bearish thesis because you were wanting a continuation of that trend? It doesn't mean necessarily that the trend is over in that sense. It sometimes is the nature of digestion in the marketplace that we then sometimes want to see what else happens with respect to the market and how does that interaction still continue further. So the next two ones I want to take a look at because they kind of speak a little bit more to a decision of sorts, a reversal patterns. The first one, of course, a little bit of a inadvertent name in that respect. A hammer, I think, is the more important one with respect to this. The main difference between is the color differentiation and where they occur at the trend itself. I think the hammer is a little bit more of one that we can take away some intuitive nature of that. The hammer, in essence, that we can see on the bottom of a trend is we see, price open, move lower, and then become overwhelmed with demand back to the upside. And why that could be important. And like I mentioned, I think this one makes a little bit more intuitive sense compared to its hanging man counterpart is that there's something that we can kind of craft a narrative around that hey, we got down to a point and that's where the buyers really just stepped in, stood in front of sellers, and the demand was enough to overwhelm the supply. Or in essence, sometimes those short sellers that were pushing price downward were forced to become buyers in that period. So hammers can be a very important, especially combined with that nature that we've been discussing so far around the idea sometimes of it happening at a very important level on the chart in particular. So I'll try to find a few that, there's never always a kind of perfect candlestick sometimes, or maybe sometimes we get a little bit of a perfect one. I would say the spirit of that one we were looking at from 2020 or 2022 was a hammer by spirit. If we think back to this one in particular, what happened? A very large gap down and a very large push by buyers upward back to some degree. So in spirit, I would say that is a hammer candlestick, even though the candle itself maybe looks a little bit more engulfing, which we'll look at here in a few moments. A good, actually, I see one sticking out to me right now. This move that we had during this period of time, and let me make it a little bit wider just to give it a little bit more nuance with this. So we had moved from this level in particular all the way down back to here. And then at this moment in time, what do we see happen? Well, we see a break of prior support to some degree, and that opens up the door to that short selling maybe. But then where do we find some buyers stepping in, essentially pushing us right back to that level of support and retesting it as resistance? So we found ourselves much lower. In this case, we closed the prior day at 41.30, opened up the next day actually at also 41.30, but we came down fairly significantly to that level that we see here in particular, 40.62. At that moment in time, that would have been roughly 1 to 2% of a move down, only for buyers to overwhelm sellers back to the upside and finish not just at where we started the day, but higher. And that's the main thing that we see there. Another kind of short-term candlestick that we maybe see in this period of time, a few days worth of a downtrend that we found here, buyers pushing us back higher. Again, the main spirit of that hammer candlestick is this concept that we opened up, moved lower, most likely found ourselves at a level of support or just an important level on the chart, and buyers were able to get us back higher. Let's look over, say, the last year. Maybe this one, kind of another perfect example. It's not perfectly at the bottom of a trend, but you can kind of see with what I mean around that same perspective that we got a move lower and then a move back higher by end of day. And that created enough momentum essentially going into the next day's session that we found ourselves moving higher on a gapping basis. Same thing can be said at this level in particular, a short term move to the downside with a day that looked climactically lower at one point of the day, but then found ourselves moving back higher. In fact, let me see if my hourly chart goes back to that long. I don't know if it will. Oh, look at that. It does. So that day in particular, what happened? Well, we open up on 531, we move higher, and then, I mean, just look at these candlesticks. You can see how much of a large move we had out of the lows of that day. And that's what creates that daily candlestick looking like a hammer. During the day itself, I bet if I don't remember, and correct me if I'm wrong, James, this looks like an FOMC meeting day for this to happen in such a large green candlestick at the 2 o'clock, 3 o'clock time frame of the day. Those meetings from a few months ago, the dates escape me at this moment, but on a daily basis, we can see how important that move was at that moment in time because it created that demand function being found in the market. So again, hammers, they tend to be those ones that are really great at a blend of those Eastern Western technical analysis. As I mentioned, if we strictly only looked, I want to see if I can zoom in as specific as this, but if we only looked at this day in particular and you said hammer candlestick, that's great. What do I do next? It doesn't work quite as well because we don't get that same amount of important information as we do as saying that, well, hey, that not only is a hammer candlestick, but it's a hammer candlestick essentially at the prior day's low, which is around an area of support that we've been at recently, and buyers were willing to be buyers at that moment in time. So that creates an additional level of nuance that we can hopefully get out of this one in particular. And the same thing can somewhat be said on its counterpart to the upside. So the next one that we would want to look at here, the one I think again makes a little bit more sense. We have the inverted hammer there, but also the shooting star candlestick. So what is a shooting star candlestick? Well, imagine if we could kind of, hold up a mirror to the idea of what a hammer candlestick is. So hammer lower, buyers overwhelm us back to the upside. It's at an important climactic low on the chart itself. A shooting star, imagine a trend to the upside, a move higher throughout the day that then sellers overwhelm us back to the downside. So the same sort of spirit within these candlesticks, but the other end of the equation where we see that move and that narrative that we can kind of point to that feels like a recent high, maybe that was an area where buyers became exhausted and sellers were able to kind of take that moment and push prices back down in a substantial way. A gravestone doji and a shooting star are pretty similar in that respect, except the only difference is that we get a little bit of actual open to close move during that period of time. I found one, I believe, from on SPY or SPX itself that we had not too long ago as well. So funny enough, kind of two major candlesticks that we were just referring to here. You could call this maybe a hammer candlestick. Again, there is somewhat of subjectivity, somewhat of an art to these types of candlesticks. And that's why I am always a tad cautious of adding and creating such objectivity in the sense that if you see a hammer or see a shooting star, that something has to happen next. We see something on a day like this. Is that technically by definition a hammer candle? Probably not. You could call that type of doji candle. The exact type of doji is escaping me. Maybe a dragonfly doji, I think is the name of this one, comparatively speaking to a gravestone doji. But we still see what we can kind of glean out of it, that movement lower, buyers push prices back higher. Even though it's not perfect in a doji versus hammer, we still are able to get some narrative out of that one in particular. On the other end, this is kind of a good example of a shooting star hammer. We opened up and moved higher, selling overwhelmed us and put us back lower. We see that relationship at the end of the day being found, that narrative has potentially changed. The buyers that were pushing us up through this period of time might have been depleted because at the end of the day, if we think about what really drives markets, it's those buyers and sellers. At a certain point, imagine you have been a buyer, maybe even at this doji, this hammer that we were just referring to. You bought it at 47.20, and in a short period of time, you got what is this, about 8% move comparatively speaking. So if you bought on this close and then you saw something here, 6.5%. You saw this happen in what is this, a couple months time, 1 month's time. So a 6% move in a 1 month's time, and you're thinking maybe I should take something off the table. At a certain point, buyers, if they were buyers and it has been profitable, they start to want to take some of those profits, monetize some of that position. And at a certain point, does that create enough selling along the way? So that is the interesting nature about some of these candlesticks, is that we are trying to find important areas on the chart where there has been some sort of narrative shift. And the last one I'll take a look at before we wrap up and look at a few different tools that we have available to us, the engulfing candlestick. If we think about the idea of decision and indecision being found in the marketplace, that is an important distinction that we get out of an engulfing candlestick. Because imagine if we have kind of the inverse of a Harami style pattern, where we get a day of decision normally on Harami and then a day of indecision. Now we get a day of indecision followed by a day of significant decision, where the full depletion of prior day's action is found during that period of time. This can happen both at the top as well as the bottom. And the same thing can be said for a couple of other candlesticks in that case. These dark cloud covers and piercing lines, very similar to engulfing Harami candles, but happen slightly above or slightly below their other counterparts. But again, that engulfing candlestick is a perfect example of those baseball bat type candlesticks that we were referring to earlier. A day of significant decision being found at that moment in time, and then driving the overall narrative of buyers versus sellers that day in particular. And I've mentioned this a few times now, but that day from 2022 was really a perfect example of what you would really want to see at a bottom. If we think about what a bottom style kind of candlestick looks like, it's really that October 22 candlestick. It's a move that was found much lower in the day, overwhelming move back higher by end of day. That was a hammer of sorts in spirit, but more importantly, an engulfing candlestick. This engulfed, 3 days worth of prior price action. All of these people who have been sellers during this potentially turned into buyers during this period of time. And that difference along the way is an important kind of distinction. Now, one of my kind of favorite recent price action memory is this level in particular. This is such an interesting case study of price action during this period of time. A 3-day gap higher move, a Harami pattern, a somewhat Harami, a bullish engulfing, followed by bearish Harami, another bearish Harami, bullish engulfing, bearish Harami, and then finally the buyers gave up. We start to see that move down. That was a very kind of interesting battle of buyers and sellers that we had in June of 2022. And that moved back down. During this period, how much did we shed in price action in really just 3 days' time? Well, we lost nearly 10% in just 3 days worth of price action, a day or two of battle back higher, and then eventually a full 10% move in essentially a week's worth of time. So we think about it from that perspective. Now, one thing that we've mentioned a few different times here, we've looked at daily candlesticks. Could you get general information about weekly candlesticks? Yeah, I would definitely say so. That weekly candlesticks, we get the same sort of nuance to some degree, that you can see how important some of these levels along the way. Where it maybe gets a little bit too broad base is our monthly candlesticks. On a very short term basis, maybe you can get a little bit out of these monthly candlesticks like this. If we close the month kind of unchanged or down, that is a kind of big narrative change along the way. You can see how important that could be on a monthly candlestick. But then as we get even further out and crazier out, a yearly candlestick, how many years do we end up red and then also follow it by another year red? Maybe not quite too often. So there's not as much that we can nearly gain out of a yearly candlestick, but it's still interesting to look at. If you look at these 3 candlesticks, I think that's a fairly interesting move. That with 2021, we had this move higher. 2022, we essentially eradicated it. 2023, we got back right to the same area, and then now we have moved higher. So it is still interesting in hindsight, but we don't get that same sort of reversal continuation components out of a longer term perspective. No, we're already towards the tail end of today. I know we've got some tools that we wanted to take a look at. Anything you wanted to add to these pieces here, James, before we do that?
No, I think that was great. I'm glad that you kind of brought up some of the engulfing aspects as well, some of those kind of engulfing candles. And I wanted to, I guess maybe kind of as you mentioned, just show some of the tools that we have both within Fidelity.com and ActiveTrader Pro. And this is going to be something where I wouldn't suggest anyone possibly use the tool to find a stock to buy just based on this alone. But I think it's good to at least, if you're looking for examples, you can use the tool to learn about some examples that are out there that are being scanned by the computers from a variety of, well, in this case, a specific third-party source. So where I want to take everyone to is to my favorite tool within Fidelity.com, and that is going to be the stock screener. So how to get here for anyone that isn't familiar with this, you're going to need to go to News and Research in the top. In the drop-down menu, choose stocks from here. It's going to actually take you over to this stock research page. And you'll want to click on either the screener tools or take you to this kind of default page here. And screen, but if we want to specifically find maybe a candlestick pattern, we can go down and find the technicals category. And we have both candlestick and multi-bar technical events. Now we only talked about candlesticks today, so I only want to focus on that. And as you can see, it's broken up between bullish and bearish and an event date within the last day, 7 days, 30 days, or 90 days. I'm going to maybe choose 30 days here, so something over the past month. Really doesn't change too much. It's still quite a lot of patterns that were identified. I'm going to click on bullish. And let's choose a few that were discussed today. How about that inverted hammer? Can do the regular hammer. There we go. Looks like it's taken a little bit slower for me here. The inside bar and an outside bar. And we'll keep it with just those four. Actually, how about let's do a grave sign? You might as well have a few here. Notice we don't have some of them labeled as the kind of shooting star, for example. But let's even include an island bottom. Not that it was specifically discussed, but you might see that some of these names might be similar to others. So I've got a variety of candlesticks now chosen, all within the bullish category. We're still looking at over 1,000 stocks, right? So we got to do something about that. I'm just going to switch this over to most popular, sort by market cap. And for the only reason of most folks have heard of large cap instead of some of these micro cap, right? 819 of them are micro cap companies. So let's see if we see some popular names up here towards the top. And I would beg to guess that many of you are familiar with these companies. We should have it sorted. Yep, it is sorted by market cap. Let's take a look to see possibly some kind of patterns that were created. So here we are. Let's first start with, how about the hammer? That one is oftentimes, I think, a little more easily identifiable pattern. It happens quite a bit. And let's just see how, in this case, the system has identified this hammer in Netflix. And there's actually two patterns. So we're going to get the benefit of looking at not only the hammer, but also what did we choose towards the end? Click on this to explain the hammer and engulfing line on July 15th and July 17th. So what we'll do from here is bring us back to ActiveTrader Pro. And sometimes this can get a little finicky on this demo account that we all share, but hopefully we can get it to work for us. So we can jump over to technical events. I know I'm still on QQQ. We'll jump over to Netflix. And here we have the different categories: classic patterns, candlestick, oscillators, and indicators. We can change the trading horizon, short-term, intermediate, or long-term. We're going to keep it short-term for the sole purpose of just ensuring that we're following along with that. What do we choose? 30 days. So that we're within that time frame. And we picked quite a few different ones. Notice how there are more listed in this category. So there are still quite a few patterns that are being scanned, even if they're not showing up within the stock screener. But again, I think the only reason someone's kind of going to go to the pattern analysis within the stock screener is maybe just to find a few stocks that are exhibiting that pattern, and then they'll take it to the chart to take a look at them. So it's requesting some of the event data. There's a few gaps that were identified in this case on the cues, but since we were focusing on Netflix, let's look at the underlying. Now we should see this together. Hopefully it shows the two signals. We should see these signals that were brought up, and here they are. As you can see, the engulfing line and the hammer. Price period on the daily. If I was on a weekly chart here, notice they'll still say, I'm going to need to switch to the daily. That's that price period that it is scanning for. So going back to the daily, and let's zoom in a little bit here because it's going to be a little tougher to find. First, we have the hammer. By clicking on it, it's going to give us a kind of a brief description, right, of what the hammer pattern is, where to look for it, in this case, where it's going to be appearing or where it doesn't appear. As we can see, a hammer appears during a downtrend, displays a longer lower shadow with a small real body at the top of the range. The price may be developing a bottom and due for a reversal to the upside. And yes, classically, the hammer is something that you would see kind of appearing on a downward trend, and it's going to signal that bullish reversal, very similar to the dragonfly doji. It's going to have that somewhat similar kind of use case for it. In this case, kind of interesting, right? As we add it to the chart, it's just going to highlight now these are our downtrend boundaries. 717. This is our hammer. Did it end up being a reversal? Well, maybe it depends on how quickly that you look on it, right? At one point, that following day, we're up. It did reverse, did it not? And of course, it ended up closing down that day. But look at the following day after that. It reversed yet again. And at one point from that closing price, we were even upwards of 2.25%. Following the prior day, we were about 1.5% to the upside. So we did get a reversal in the very, 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 very short term, just one, two candles after it. But ultimately, kind of that downtrend-ish somewhat continued, although you may say, well, hey, James, did it really continue or did it just change? Right? This was the downtrend that they identified in this pattern. And as we can see, it did get broken. The downtrend did kind of end up somewhat changing here. And this is in the near term. Interestingly enough, if we focus on kind of Netflix identified downtrend, this is coming from Recognia. This was that channel that they established. We've been keeping our closes within the trend, but today we've got a candle outside of that kind of downward trend that they've identified. And in the same respect, if we were to click on the engulfing line bullish, we can add that to the chart. Date of 7/15. Here is our bullish engulfing. And what I like about this is, well, okay, let's take a look, right? We can view the details. Short-term bullish, right? Following a clear downtrend. They've also identified the downtrend. And these were both bullish signals, but they're part of this downtrend. And we see that Netflix has continued further down from the identification of these signals. However, could you say maybe they were still correct? And possibly, because even after those signals were created, both the first and the second, the first one that we talked about, the hammer, right? We did have roughly 1.5 to right 2% rise in price in the very, very short term, just 1 over 2 candles. And even in this case, this was identified on this day. It did open the next day up 1%. So if you were really sticking to that very, very short-term perspective that possibly Recogni is quoting on in this, well, it was a bullish move following, but of course they still haven't been able to overcome this somewhat downward trending environment that Netflix is in. So that again is meant to just show some of the tools that you can use, both the stock screener, or you can use the chart patterns tool within any underlying that you're looking for. One other one, I know we're already over where we popped up on that list, actually got a bearish signal in this case, that bearish engulfing, and kind of an interesting turn of events, right, with this gap related to earnings. The gap was mentioned here. It's not necessarily considered bullish or bearish, just the gap in of itself, although a gap to the downside may be considered bearish to some respect. And then we get the inverted hammer, again, a short-term kind of bullish pattern, similar to kind of that gravestone doji that occurs on a downtrend. So in at least the patterns that we looked at from a very, very short term, just the next candle over, we can say, hey, these were somewhat kind of accurate calls here, right? The bearish engulfing did lead to a bearish action. The falling candle was timed perfectly with earnings. We had our inverted hammer here, timed with now a rise in price and still continuing, right, that upward movement. So hopefully that was just a quick highlight of those tools. Igor, I did see kind of your comment there. Where can I get the slide presentation? Well, the good news is that this is part of our classroom kind of slide deck, even though we don't actually cover this in the class. And maybe Andrew, if you have everything all set, I can let you go ahead and answer that one.
Yep, saw that question as well. Wanted to pull it up for Igor before we wrapped up. Like James mentioned, this is part of the actual classroom session on technical analysis. This is, I believe, week 4 of technical analysis. Correct me if I'm wrong there, James, but you do have the ability to download these slides. Actually, it may not matter anymore. I think all of the slides are aggregated on this page in particular, but I'll show how to get there one more time. But this is all part of the technical analysis slide deck. In fact, you can actually learn a lot of other pieces of information on technical analysis if you are so curious. Fidelity.com/classrooms is the direct link. You can also find yourself on the events flyout, trading desk or trading strategy desk classes. Again, technical analysis is the slide deck for this. And just if you're curious, this will be beginning anew here next week, August 2nd, which will be, I believe, Friday of next week. You can attend and be part of that technical analysis basics classroom session. So that being said, I know we're already a handful of minutes over here today. Do appreciate everyone joining us here. As always, we've got one more session at the end of the day of afternoon market briefing. If you want to see 2 of our colleagues take a look at the markets in real time, taking a look at technical analysis and the events of today in particular, feel free to join us at 4 o'clock. Otherwise, do appreciate everyone, as I mentioned. Look forward to seeing everyone in these future sessions. Hope everyone has a great day. Thanks.